Today I'll discuss tax-effective management of Australian equity portfolios. So let's begin with a question. Investors want after-tax returns, but managers currently seek pre-tax returns. Often this is to the detriment of their investors. Altering mandates to an after-tax basis is the best way that you can align the interests of managers with your fund members. This is a real-life example, and it comes from one of Warakirri's multi-manager Australian equity funds. I've selected 3 managers, and these are their pre-tax and pre-fee returns to the 30th of June 2007 in the first column. If you only had pre-tax reporting, you'd conclude that Manager A performed a little bit better than Manager B, and both managers A and B were better than Manager C. However, if you had after-tax reporting, you'd make a different conclusion. As you can see in the middle column, Manager B comfortably produced the highest after-tax return. Manager C, despite producing the weakest pre-tax return, actually produced a better after-tax return than Manager A. And Manager A, whilst they had the highest pre-tax return, they actually had the lowest after-tax return. So why is that? Firstly, they'll have lower realisation of nominal capital gains. They'll have higher franking credits, and they will participate in buyback. Whilst these numbers only represent a short period, the relative tax efficiency between the managers is consistent with my longer-term expectations. Manager B is simply more tax efficient. So the other managers must produce higher pre-tax returns just to keep up. In this table, I've tried to quantify the opportunity for a tax-aware manager to add after-tax value. Clearly, the benefit from efficient turnover and high franking credits is achievable every year. Buyback participation is more a function of opportunity. In a good year, you could add up to 1%. In total, the benefits of tax-aware management should be in the range of probably 0.5% to 1% every year. To put this in context, the median active manager only outperforms the index by around 2% per annum, and that's on a pre-tax and a pre-fee basis. I suspect if we looked at the average manager on an after-tax basis against an after-tax benchmark, based on their current behaviour, I don't think they'd even look that good. However, if managers change their behaviour and adopt more tax-aware strategies, I believe active management will prove to add value for members and justify the fees charged for buybacks. This is another real-life example. The net after-tax buybacks quoted are for superannuation investors, and they're shown in the table there. In 2004-05, the benefit was very large. Since then, the benefit has reduced. This is due to greater participation by investors. Still, 40 basis points per annum is a useful increment to fund returns. As you'd be aware, the Board of Taxation is currently reviewing the tax treatment of off-market buybacks. Off-market buybacks are a valuable capital management tool for companies, and all shareholders benefit from them. They are broadly revenue neutral to the government, as the Tax Commissioner uses his power under the general anti-avoidance provisions in the Tax Act to protect revenue. So I would urge the superannuation industry to continue to lobby government to protect the current off-market buyback arrangements. This is in all your members' interest. So I believe tax-aware mandates are the future in Australian equities. There's clear benefits, and the strategies are relatively simple. The question is, how do we as buyers of Australian equity products go about improving the tax efficiency of our managers? We need to alter managers' behaviour. Firstly, we need to measure and report after-tax performance. Managers will respond more positively if the impact of poor behaviour and the benefit of good behaviour can be quantified and explained to them. It's an education process. Managers are highly intelligent, they're very competitive. They'll work to the rules that we set for them. I want to particularly highlight managers' competitive streak. If after-tax performance surveys are produced, those managers who come up poorly will make changes. They'll do everything in their power to alter their behaviour and improve their ranking. And if this doesn't improve a manager's performance, then you don't want that manager investing your members' money anyway. Remuneration. Performance fees must be aligned with the performance that members received. They should only be paid on after-tax outperformance, not pre-tax. For this to be measured accurately, we'll also need after-tax benchmarks. I'm going to list some examples of poor behaviour and the changes that we've observed in the last year since we've been pressing our managers to become more tax efficient. At best, only 20% of managers knew their tax parcels. This resulted in higher tax. In the last year, that number's improved. It's now up to around 50%. But it's fundamental that all managers know their tax parcels. They need to track them. Previously, only 1 in 4 managers would participate in off-market share buybacks if they weren't directed to by their investors. Now, virtually all managers will liaise with their investors. This is an encouraging change. Though managers are still reluctant to make the investment decision, despite that being their expertise. On average, managers don't value franking credits at 100%. The number's more like 50 or 75% of their true value. To date, we've seen little change in this measure. Why? Because managers don't believe the market will fully reward them. This is an opportunity that managers who are tax aware exploit year after year. Importantly, if managers were measured on an after-tax basis, this market inefficiency would likely disappear. So what has Warakirri done? We've developed a practical after-tax performance calculation methodology, and that followed input from 21 Australian equity managers. It can be applied to both portfolios and also to benchmarks. And we're happy to make this freely available to everybody in the industry. It's something we believe strongly in. We think it's very important that fund managers, these are the people actually managing the money, were involved in developing the after-tax parameters. Above all else, the parameters had to be practical. The goal of the system is to encourage managers to consider tax when they're making investment decisions. This may only take a few minutes of thought if an efficient tax information system is set up, and it will produce significant results. So, we've changed our Australian equity mandates to an after-tax basis as of 1 July 2007. We're now measuring manager and investor after-tax performance against after-tax benchmarks. Remuneration structures have been altered. Performance fees are now based on after-tax alpha, and that's for both our managers and also for the fees that Warakirri charge. So the interests of managers and investors are now aligned. Let's turn to some implementation issues. Virtually all funds outsource accounting, tax and unit pricing functions to the custodian. The custodian is therefore pivotal to an after-tax system. Funds may also benefit from investigating tax parcel selection methodologies with their custodian. So clearly after-tax is more complicated than pre-tax. Just as auditors currently have a role in reviewing a fund's after-tax unit prices or crediting rates, and also their manager returns, they'll be important in providing comfort to all stakeholders with after-tax. An independently calculated after-tax benchmark is required. Warakirri is using ITG to do this. Currently, they're the only index provider in the country. As demand for these services grows, we would expect more providers to emerge. Managers are very content in a pre-tax world, as a single benchmark can be used for all portfolios. In an after-tax world, a unique benchmark must be used for each portfolio, as the timing and magnitude of cash flows impacts after-tax returns. Consequently, it's reasonable that verification of the after-tax benchmark returns be provided to managers. So how's Warakirri solving this problem? We've committed the necessary resources internally to mirror the benchmark calculation. We're doing this for 35 benchmarks every day. Solving this same problem is probably the biggest challenge for super funds. So how will you provide this same level of comfort to your managers? An option may be to employ 2 benchmark providers. Though the obvious question becomes, what do you do when they come up with different numbers? Alternatively, the industry may look to employ an actuarial consulting business to undertake the verification work. From an audit perspective, we've committed to both a controls and an operational audit as part of our responsibilities to managers. The after-tax benchmark calculation process is probably the most complicated part of after-tax. If tax-effective mandates are to become the norm in Australian equities, then it's important that an industry standard methodology evolve. Managers can handle operating one after-tax system. If they're required to manage 3 or 4 different systems, then the complexity may outweigh the benefits. Tax awareness should be viewed as one factor in maximising after-tax returns, but not necessarily the main factor. Effective methodologies must provide for both capital gains and franking credits. Member equity requires the provisioning for tax on unrealised gains is made. A unique benchmark is required for each portfolio. Performance surveys should, going forward, use after-tax alpha. This will reveal the true performance of the manager. and again, independent calculation of benchmarks is necessary. To summarise, members' retirements are funded by after-tax, not pre-tax performance. After-tax returns and rankings are the only ones that count. Introducing after-tax mandates is in your members' interests. Manager behaviour is improving, but there's still further work required. I would encourage everyone here to be talking to their managers, forcing them to adopt after-tax reporting. I think that is the first step. Is your fund planning to adopt after-tax reporting? Are you thinking about tax-effective investment strategies? If you're not, I think you may well be left behind. Thank you.
In the next 15 minutes or so, we're going to talk a little bit about Challenger's practical approach to managing a tax-effective style. So really, we see two ways to focus on tax, both as a core manager and then, as I said, in terms of product innovation, in terms of tax-focused investments and what that means. So from a core manager's perspective, the first point I want to make is that pre-tax returns are the biggest driver of post-tax returns, and Richard would agree with that. If you look at any survey on a one-year basis between the first and fourth quartile managers, you might see 4 to 5% per annum differential in pre-tax performance. And while I agree with Richard, 0 to 2% is certainly achievable in a tax sense, pre-tax returns is still going to be the biggest driver of your total after-tax return. So what can we do doing in our core funds as managers to address this challenge of tax effectiveness? Well, taking Richard's three areas of tax efficiency in turn, firstly, franking credits. We see franking credits as a process issue. So the way we run our investments is we value all companies on a discounted cash flow basis, and that basis includes clearly projecting out the cash flows of each business, but also projecting out the distribution of franking credits, and we value those. And it can be quite significant. In the case of a domestically orientated company that pays out quite a high level of dividends, it can be up to 14% of our DCF valuation or our valuation of the company. So we believe our investment process already captures franking. And we don't agree with the fact that you want to actually put additional value on franking in that circumstance. As far as gain deferral goes, which is the second point that Richard mentioned, this, to our mind, is more of a systems issue. Gain deferral is obviously, in terms of holding shares for more than 12 months, is very much portfolio specific. And in the case of our core strategy, we can run between 20 and 30 discrete mandates or retail products. So it's very difficult for the individual analysts, of which I'm one, to actually understand, I guess, the tax parcels across 20 different portfolios where we're making a recommendation to sell a particular security. But what you can do is you can invest in systems, and you can make systems modifications that at least will allow the portfolio manager, in the case of Peter's core funds, to understand the tax implications are different for different funds before executing the decision. The third point about buybacks, well, I also see that as a franking issue, so therefore it's a process issue. In our discounted cash flow valuations, we address what we think is the optimal capital structure of every company. And of course, we compare that to the actual capital when you derive your valuation. And that way, companies that are under-leveraged and have excess franking credits get a boost in their valuation. So we think, particularly with buybacks, you need to have an investment process that captures these ahead of time. There's no point chasing them after they're announced, because as you've seen, stocks jump significantly on the day. And one of the changes I anticipate from this Board of Taxation review is closing that window with which you can purchase shares. You have to have really been set in the company before the announcement is made. So what am I saying about core strategies? Well, what we're saying is pre-tax return is the biggest driver, and you want your managers to be doing some things. You want them to be including franking in the investment process, and you can certainly check that. And you want them to be having systems enhancements to prevent unnecessary turnover in companies where the stock hasn't been held for more than 12 months. But you don't want them to go too far, because if they push it too far, they end up skewing the portfolio away from their investment philosophy and might end up taking risks which actually could in the end actually be prejudicial to performance. So what we see is this role for a new type of product which can coexist with these funds, which is a tax-focused fund. And a tax-focused fund or tax-effective income fund, of which we have one, but there are many in the market these days, is a fund that will actually target franked dividends ahead of capital growth. So capital growth actually becomes a secondary objective. But in so doing, in actually saying, well, hang on, I'm actually going to buy Telstra over BHP, even though the discounted cash flow valuation might not support that, just because Telstra has extra franking credits, you can quickly see that what that does is it actually creates some risks in your portfolio. So it creates some capital risks, even though you're achieving all these franking credits. And this is where we see quite a big role for derivatives to come into play in a tax-effective sense. If you're investing in companies because they have franking credits ahead of capital growth, but you judge from a fundamental perspective that there's capital risk there, you can actually, using derivatives, you can actually purchase put options, and you can sell call options over those companies to effectively reduce your capital risk, even though you're maximizing your franking benefits. But these funds will have very different risk-return characteristics to a core portfolio, and of course are suitable in certain circumstances. For example, the use of derivatives, while I think is very important in an after-tax sense, does create some challenges. It's an absolute return instrument. It's not in the benchmark. So it will increase tracking error in every instance. And of course, what it does do, though, is lower the absolute volatility of the fund if used in the right way. So it creates a very defensive product, but it will mean that you will lag rising markets as well. So there's a classic trade-off that's occurring. But in the end, we see a role for these funds that maximize franked income, minimize capital gains tax, participate in buybacks, but they need to use derivatives to address the skews in the portfolio that they're creating by pushing tax to the limits, by pushing tax efficiency to the limits. And those derivatives can reduce risk, but they also reduce absolute return. And I'll show you a practical example of how we see that. In the first column there, we have the ASX 200 over the last 2 decades or so, and you can quickly see that we include an income return of, say, 4%, imputation credits of 1%, capital growth of 7%, and you get about a 12% total return. So already you can see that a key point there is that the biggest driver of total return is actual capital growth, which reinforces the point that pre-tax return is the biggest driver. But what about a fund, which is the tax-focused fund on the right, which actually tries to increase income and tries to increase franking, but uses derivatives to manage the risks in doing so, and in so doing creates a lower risk product, but also a lower total return product? That's your classic trade-off that you face in a tax-focused fund. And as I said, maybe in an accumulation sense, the core fund with some sensible tax management makes the most sense, but in a post-retirement phase or in a blended portfolio, there might be a role for a particularly tax-focused fund that does things differently. And we see these tax-focused funds almost like a niche asset class, a bit like infrastructure or property. High yield, but lots of tax benefits, less capital growth, lower risk. And we see it as almost the birth of a new asset class within Australian equities. So putting those numbers on a long-term chart, you can see that just looking at the core portfolio, if this is return and risk on the two axes, if you add franking credits to the market return on the top right, you're actually raising the efficient frontier. Franking credits are very much a pre-tax cash flow, and we think should be at the very least included in performance. Of course, Rich has gone one step further to actually include the tax liability as well, but we're saying at the very least include franking and then move towards full after-tax reporting. And as you can see, once you start including franking, the relative attractiveness of equities over bonds becomes even more interesting. And the reason we came up with a product is saying, well, if you can, the only 2 reasons which we could see that you would use bonds in a portfolio would be 1 for the income yield and 2 for the diversification. Clearly in some environments, bonds offer really good diversification benefits, particularly in recessionary environments, for example. But what we're saying is if you can use equities to actually get a similar yield to bonds, but in an after-tax sense, you can actually get a better yield than bonds because of the substantial franking credits, then that really just leaves diversification as the sole reason for using bonds. Now, clearly we're not saying that it's the end of bonds. We're just saying equities can be used in an after-tax sense in very creative ways. And if I just look at the last 3 years, so what we've done here is we've got our cash, our bonds, and our equities, but we've introduced this new type of fund, which, as you can see, has less return than the market as a whole, but also has less risk. But what the fund is trying to do is maximize the income and the tax alpha, so to speak. So when Richard showed you some tax rates early on in the 0 to 10% range, we actually think an achievable target is actually to have a negative tax rate for a fund like this. So in other words, the franking credits are larger than the capital gains tax liability, particularly at a 15% superannuation tax level. Clearly, for high net worths, it's much more difficult, but you have a unique opportunity with the tax rates applying to superannuation funds to actually get funds that create negative tax rates, where you want to see franking credits larger than the capital gains tax liability. But because you're investing in stocks that maybe the alpha or core manager wouldn't invest in, you need to use derivatives to manage stock-specific risk. So you lower the risk, you create a very defensive product, but your classic trade-off is in total return terms. So really, neither is better than the other. It's what's more appropriate in certain circumstances. And as with everything else, it just comes down to blending options. So just to conclude, as far as the core funds go, pre-tax return is the biggest driver of total returns. But what you want to see is managers' investment process capture franking. That's really important. And then you want to see some systems development, systems enhancement to limit the sale of short gains or stocks that have been held for less than 12 months. But in the end, you almost don't want your core managers to deviate from their underlying philosophy, because they could invest in stocks which haven't fitted their historical process. And they might improve tax, but they might actually end up losing capital. But what we're saying is there's a role for funds that will maximize tax benefits, reduce risk, but also have lower total return in strongly rising conditions. And in the end of the day, what you want to see from your managers is that tax awareness plays a big role in the core funds, and you want to see some product innovation that takes tax to the next level.
Rob Fowler from Hester Super. Question to Richard, really. Can you just expand a bit on the complexities of having the individual benchmarks for each of the managers?
I mean, in a sense, it's just having a benchmark provider. We're basically running 35 benchmarks every day. So that's one for every portfolio, one at fund level, and then also we have individual investor benchmarks for our very large investors. Really, it's just computing power. If you can calculate one benchmark, you can calculate 1,000.
Fiona Trafford-Walker from Frontier. I had a question for Richard, which was just to understand the responses from the managers when you went to them with this project. I know you've been working on it for some time, so just how you managed to get them over the line, how big a job was it, where the positive responses came from, not by name, but what kinds of firms were a bit reluctant, those sorts of things.
We've been talking to our managers about tax efficiency for probably 18 months. We gave them a lot of lead time. We always nominated that 1 July 2007 would be the date we would start it. I guess, in a sense, a lot of them are happy to do it for us because it can be a little bit pioneering. They can look at it in one individual portfolio and still run their existing business whilst they learn about Aftertax and what it means. I suspect some of them, if other people went to them today, might be reluctant to commit. But they all realise that theoretically it's in members' interests. Every single one of them to a man agreed that that's what everyone should be doing.
Gary Johnston, Axis. A question for Richard. Have you had any reports from your managers of dilemmas that they find themselves in operating under this model in terms of timing of realisation of gains or asset selection?
The reality is, if you looked at Neil's presentation, he talked about what they're doing with their core portfolio and then a more specific product. Really, we're probably more at the core portfolio angle. We're basically saying to our managers, we just want you to maximise your after-tax return. I don't mind if you turn your portfolio over 10 times a year, but what you've got to understand is that the real return that counts is the after-tax return. We, I guess, had evidence. We actually went back and looked at the last 2 financial years, and we actually found a staggering amount of times when a manager would sell a stock that they'd held for between 11.5 and 12 months. Now, you can have valid reasons for that. For instance, if a stock just put out an earnings grade and the share price didn't fall as much as the manager thought it should, then it's a very valid reason to sell the stock. But to me, it's not acceptable when a manager just sold it because they didn't know how long they'd held it for. To me, if that's regarded as a dilemma, then I don't think that's acceptable from a manager. What we were very keen on in designing the system was that we went out and talked to all our managers. We ran workshops for them. We ran a web forum for them. We've given everyone the opportunity to put their views forward, and we made quite a few changes from our original proposal, and that was based on the feedback of managers. So what we've tried to design is a practical system that can actually be used by the managers out there. In reality, there's no perfect system. The only way you know what your after-tax return is after you've liquidated a portfolio. And even then you'll only know the starting point and the end point. The path to get there is really just an estimation. So really what we're trying to do is just provide some boundaries around getting something which is practical and something that managers can work to. I don't know if Neil has comments on that.
Yeah, but I guess from our perspective, what have we changed in our core fund? Well, franking credits we believe we're properly accounting for anyway and getting our share of buyback activity. So the real change is in deferring the capital gains, and that's something obviously we probably give a bit more thought to than we might have a couple of years ago. But that's where I see quite a big role for, even in the core portfolio, for greater use of derivatives going forward. So I guess as far as the trustees go, you need to think about the mandates and the risk controls that are permitted, and think about derivatives in an exposure sense, and not only as I guess an evil instrument. If they're used correctly in the right controls, of course they can significantly enhance after-tax performance.
What's been going through my mind is what about international equities and whether the same principles apply. Obviously we don't have franking credits, but there are other withholding tax credits and different tax items there, so interesting your views on that.
Yeah, look, I think so, but I think what you've got to understand with super funds is that because the tax rate is low, 15 or 10%, and there's not much of a difference between a nominal capital gain and a discount capital gain, franking credits really dominate. At the margin, I guess it's relevant, but I don't see it as an enormous issue.